Hi traders, it's John. It's time for a general market update before the Easter weekend. It was kind of a slow week, but let's look into it all and see what we can learn. So again, the reminder is this is a presentation made by RKi LLC, and I'm an individual growth stock investor. So our agenda, we're going to get into the indices. We're going to look at market breadth, really take a good close look. I have a section called Where is the Strength? Follow the leader. And then I'll share my RKi picks that were made at the end of December. Since it's the end of Q1, we'll do an update, see how they're doing, and then we'll wrap up. So before we launch into the general market update, a couple of announcements. One is the next Boston IBD meetup, which is a free meetup, will be on April 10th in a couple of weeks. We've got a great speaker. We've got Greg Morton of the East Greenville IBD meetup, and he's going to be speaking about investing in IPOs. So it's a great time to talk about IPOs in the market, and Greg has a lot of knowledge. So if you're not a member of the Boston IBD meetup, all you got to do is go to meetup.com and search for Boston Investors Business Daily Meetup Group and provide your email, and we'll get you on the email list and you'll never miss a meeting. So that's coming up where you do have to register for the event. So hopefully you'll do that. Also, another reminder, RKi Insights is getting closer to launching. Anybody who's interested in the early bird offering, which will probably be sometime in the middle of May, just send me an email to support@RKiinsights.com. I'll get you on the list. At the Boston meetup coming up, I'm going to share a few more details about what RKi Insights is all about. Okay, let's delve into the indices and look at the breadth. So I wanted to start simply with something small, but probably important. This is a chart showing the NASDAQ in black and the triple Qs in this dark green color. And I'm showing from February 1st. And you can see in the last 2 weeks, week and a half, 2 weeks, the NASDAQ and the Qs have essentially gone pretty much sideways. But you'll notice that mid caps, which is the MDY, and small caps, IWM, actually outperformed the last couple of days. So this could be a good sign that maybe there's rotation going on. We're going to get some more broadening of the rally. It's a really small, subtle thing, but hopefully it's an indication that the mid caps and small caps are going to start to outperform on a longer term basis. So here's the S&P 500. A couple points I wanted to make on this. Obviously, I think this is probably the strongest index right now, certainly stronger than the NASDAQ. You'll notice this purple line, this is the 20 EMA, which has definitely been kind of the controlling intermediate trend moving average for the S&P 500. It's gotten support there 1, 2, 3, 4, 5, at least 6 times. So we want to keep an eye on that. If we get a pullback and break that, that would be a change in character, and we'd want to pay more attention. So that's the first thing. And also we have the 5,000 psychological level, which right now is below the 50-day moving average. So we would expect support at the 50-day or at 5,000. So if we see some changing characters and these break, we could be looking at maybe a deeper correction. So a couple things to look at on the new highs and new lows, what I've got plotted down at the bottom. You'll see that the last attempt a couple days ago, new highs and new lows. You see the market made a new high intraday, then closed very, very weak. But we had really a spike in the number of new highs. So we're getting new highs, but they didn't hold because the index came back down. And you can see that this latest rally over the last couple of days has also reached for that new high level and closed about mid-range. And the new highs have actually backed off a bit. So this is a little bit of a subtle thing. Could be a concern that, again, maybe the index is getting a little bit tired here. We're seeing less new highs on these attempts. Now, I bring this up, and an example would be going back to about mid-December. You'll notice that here's another situation where we had a spike in the new highs, clear spike, and you can see that the index made new highs, then backed off to close mid-range. And it did portend a little bit of weakness coming up. The market tried to rally again, and then you can see here that the market had a little bit of a sharp drop and the new highs started to back off. So that sequence of things, showed us that maybe the market was getting a little tired. You can see here that we went sideways for a couple of weeks, but we grabbed the 20-day. So it's similar to what we're seeing. Also, I've shown in early February a similar dynamic where we get a spike in new highs on the last couple of weeks, but they close weak on the index. And you'll see here there's an air pocket. Someone mentioned they wanted to know what an air pocket was. It's this kind of situation where there's really no bidders there and you can drop and have a mini gap of some sorts. So just something to keep in mind. It may not develop into anything serious, but as a little subtle thing to be noting on the chart. So this is the NASDAQ, again, looking with new highs and new lows. We've talked about this period here, 2 to 3 weeks. We had a lot of distribution in the NASDAQ, but the good news is it's still hanging in there. It's tried to push higher. And again, you can see this. We try to make new highs. We close very, very low in the range on a little bit of a spike in the new highs. So we're getting some new highs and some issues, but they're backing off very quickly is the concept. So poor close. And again, we've gone kind of sideways the last few days. So the NASDAQ is hanging in there. It's good to see the last couple of days, the new lows have dried up. But you can see in here there were a clustering of new lows above the 50 level, which is not what we want to see. So again, it just seems that the index is a little tired here, but we'll play it day by day. So where is the strength? Sorry about that. So I've pulled up the Dow Jones Industrials in this light blue color. And I've also put on this chart the Dow Jones Transports. If you're somebody who follows Dow theory, usually you want to see when the industrials make a high, you want to see the transports confirm that new high. And you can see here that was happening at the beginning of the rally. We were getting new highs in the industrials and we were getting new highs in the transports. That's last time that happened, backed off here. You can see where I've drawn the line. Ever since then, we've had 1, 2, at least 3 new highs in the industrials. But you can see that the transports have gone completely sideways for the past 7 weeks. They're not confirming the strength we're seeing in the Dow Jones Industrials. Material stocks have been strong and the industrial stocks have been strong. But this is another sign of a little bit of a divergence that maybe the market is getting a little tired. Now in this chart, this is the S&P high beta, and I've divided it by the S&P low volatility. And when you line these up, this is the S&P on the top chart in a line chart, and this is the high beta divided by low volatility. So when the line is moving up, that means high beta stocks, which tend to be growth stocks, are moving up. When the line's moving down, that means that low volatility, safer defensive stocks are outperforming. So in generally speaking, this ratio of high beta kind of synchronizes and correlates to the S&P. So you can see this period here where the S&P is rising, we see high beta stocks since November have been outperforming. And then we can see here that the S&P has continued to march higher, though it's gotten quite choppy with this ratio. And you can see that even with the S&P marching higher the last few weeks and hitting new highs, you can see that the high beta is no longer outperforming low volatility, and we're getting more of a sideways chop the past 7 weeks. Again, that's just telling us that high beta, i.e. growth, tech stocks, riskier stocks, small cap stocks, they're not outperforming. And we've seen that in the charts, and it's just something to be aware of. You can see back here, the October correction, when we went from August to October, you can see there's the 3 waves down in the correction in the S&P, and you can see high beta doesn't perform well when we're in a correction. So it's something to keep on our radar. As I mentioned, the strength really is in material stocks and the industrial stocks. We shared these last week. They're making new highs. So let's move on to something called follow the leader. And the leader of the market, at least in terms of growth stocks, is obviously NVIDIA. So looking at this chart, there's some interesting things going on. And I'll start back in the chart way back in September. NVIDIA had a big earnings gap up. It bumped into the 500 psychological level and it backed off. And that was really the day that NVIDIA started to base out. You can see it was bound by the 500 level and the 1 trillion valuation, which was roughly about 410 on the chart. And you can see the stock came all the way down to that valuation level a couple of times. Then it bounced up against the upper part of the chart. But again, over a 4-month period, gradually NVIDIA tightened up between these two key levels before it broke out in early 2024, and it's been on a tear since. So here we are now, we're up against the 1,000 psychological level, and we have the 2 trillion valuation about at 820. So we had this huge day here where we had the reversal in NVIDIA. We formed a high volume close, which I've shown in this dotted line. And we're kind of sandwiched between a number of different levels. And the question is NVIDIA going to essentially base out again somewhere between these two levels? It looks like it's getting support at the 20-day. The 20-day is coinciding with this high volume close. So there seems to be support there. It's possible we come all the way back down to the 2 trillion level and get support, or even the 50-day. So it just means that, possibly NVIDIA needs to rest a bit. It's doubled again, which is an incredible move for a large stock. So we'll keep an eye on that. And the reason we do keep an eye on that is because it's the leader. Now, the big leader is usually the last stock to kind of correct and base out. And we showed that 3 or 4 weeks ago relative to Cisco back in the 90s. So the action in NVIDIA has really been completely normal so far. Might need a rest here between these levels, as I mentioned. And, thinking about the broader tech area, tech has already been basing. There's many stocks that have already backed off and they're starting to base. NVIDIA might be the last one to actually base out. So I'm mentioning some of this leadership that's starting to stall out. This last rally attempt that we had to try and get to new highs, you can see Uber made a rally and then it basically has stalled out and come back down. Here's Arista Networks. It actually broke out above some resistance, didn't last long, only a couple days, and you can see where it's come back in, and you can see the chart showing increase in selling volume. So there's some distribution going on up here. And here's Nutanix. Again, tried to make a rally, and then it's stalled out completely, and it's come in. And you can see here, number of distribution days showing up on the Nutanix chart. Nothing terribly concerning yet because we still have the 50-day as support. Generally, stocks are somewhere around their 20 days. It just means that maybe they're going to need to rest a little bit. If it gets below the 50-day, then we might get more concerned of a deeper correction. So keep your eye on the leaders. Again, this is Nutanix, some distribution in the chart. Here's CrowdStrike. CrowdStrike freaked out on its earnings report, had this very, very wild day and closed very, very poorly. Certainly distribution was going on for a couple of days. Now, since that point, the stock has not broken down. If you notice, the purple line is our 20 EMA. And really, the stock has been supported at the 20 for 2 weeks now. You can see it's been dancing with it, but it tends to get support. That's actually pretty constructive. And you'll notice that the volatility of the stock is really starting to calm down a little bit. There is some spikes. There is a little bit of distribution going on in the stock, but we're not seeing people run for the exits yet. And we also have the 50-day moving average here that could act as support as this chart progresses. So the leaders have been basing out. So let's go to the RKi Picks that I made back in December, since we've actually concluded quarter number 1. So here's the table. These are the picks that I made on December 22nd. And here's their close as of yesterday. And here's the gains and losses. You'll see that there's quite a spread here, and we're going to dig in a little bit. You can see there's been some real big winners so far in the first quarter with United Rentals, Toll Brothers, CrowdStrike. But there's also been some pretty disappointing ones. Affirm is really disappointing, had a very poor quarter. And then we had some earning gaps down, which we're going to talk about. But overall, after the first quarter, it's a plus 2%. Not what we'd like to see, but don't forget, these are yearly picks, so there's still 3 quarters to go. Now you can see here, I've plotted from the beginning of the year, the NASDAQ is in black. Okay, so all of these line charts for these symbols shows these are the stocks that are outperforming the NASDAQ. there's a basket of them, and they were really outperforming by early February, but generally they've come back in and gone sideways. These here down at the bottom below the NASDAQ, these stocks are green, as you can see on the table, but they're underperforming the NASDAQ. Shop's been a disappointment. So, we've had some winners, but let's look at some of the losers now. So, same idea. Here's the NASDAQ in black, and we're trying to see, well, let's look at the performers. So you can see here that there's 3 stocks here that had nasty gap downs on earnings. Snowflake had a bad reaction to earnings. Shop had a bad reaction to earnings and continued lower. Elastic had a bad reaction to earnings and taking it lower. So there's been some really stocks that were doing well, but they really didn't get through earnings too well. I noticed one of my picks, which was actually Nugget, which was performing probably the worst through the end of February, has had a very strong March as gold has risen to a new high. So you can see here, generally, Nugget has been outperforming the last 4 weeks. It's still 5% off where I picked it. But again, we've got 3 quarters to go. We'll keep monitoring this. It's kind of interesting to see where we go. We had those gap downs really hurt us. GitLab and Snow and some others. So let's wrap up, see where we are for the week. So we really did not see a lot of follow through from that Powell rally day. The growth stocks have generally still stalled out. So if you're a growth stock investor, you got to be very, very cautious here. We're seeing signs of distribution. We're seeing signs of sideways action. Now, if you're investing in the energy stocks, the industrial stocks, you're probably doing well. Clearly, the S&P is the leading index. Are we holding support? Yes, we are holding support so far. Both indexes are still above the 20 EMA, which is good. The power trend's still in place, so we don't want to forget that. New highs, new lows. The S&P situation is much better than the NASDAQ. A little bit of caution with that, the way I explained the air pockets that could be a concern, but I'm going to say more on the minor side. It's a subtlety. Now, the action of the leading stocks, again, the last rally we attempted this week was met with more stalling and distribution. So tech has already been starting to pull in to make bases over the last 4 or 5 weeks. So they've already started, and we're now seeing even NVIDIA is starting to pause. So keep an eye on the real leadership of the market, and we'll see if we can get some stabilization, build bases, and then maybe launch for another bull leg. Exposure levels, I think, last week we talked about putting a few pilot positions out. If you're getting stopped out on your pilots, and I got stopped out on 2 of my pilots, it's just telling you that growth is not ready to go and that you really need to back off. I think exposure levels should probably be in the 20 to 30% range. If you have a big cushion in a stock, and I'll say that's got to be at least gains of at least 40% or more, you really need to make a decision. You need to decide if you could hold all the way down to the 10-week line and experience that drawdown and be okay with it. If you're a position trader and you want to hold for a big move, you're probably going to have to hold down to the 10-week moving average. So if you can stomach that drawdown and you want to hold your position, then sit tight and don't give up your position. But if that makes you very, very uncomfortable to give back a chunk of your gains, then maybe you should be scaling down the position or perhaps even taking all of your gains and banking them. Every person is different. Every person is either up or down on the year. So you have to make a decision about how you want to handle that. The important thing is think about it carefully and really make your plan. So the quote of the week is from Ed Sakota. Trying to trade during a losing streak is emotionally devastating. Trying to play catch up is lethal. The reason I put this quote in there is if you've been getting stopped out in some pilots, maybe some of your other positions have been coming down and getting stopped out, you have to be patient and willing to sit on the sidelines. Don't overtrade, jump back in at every little nuance because you'll just get chopped up. And if you try to play catch up and catch up to the money that maybe you gave back, you'll make bad trades. and it'll really, really get you into a deeper and deeper hole. So try to remain patient and just definitely have a plan of attack of how you're going to defend your account and the signs you'll need to know that you should be more aggressive in your account. Well, that's the general market update for March 29th. Thanks for listening, everyone. We'll see you all soon and have a wonderful Easter with your family and friends.